Welcome to Capital Cosm, everybody. Today, I have a very special treat for you. We have Patrick Karim on the show. Patrick, thank you for coming on.
It's my honor. Hopefully, we get to share some good charts and give some value to all your viewers.
Most definitely. I'm sure the viewers would be really excited to have you on. Of course, no introduction needed, but let's go with an introduction nonetheless. Give us a brief, or as long as you want to give it, actually. Give us a background on who you are and what brought you into technical analysis and trading and investing in general.
Well, guys, look, my background's in the IT, so I was a Linux system engineer there for most of my career. But like most people, you have a day job, you work, you have a career, start accumulating funds, and one day you say, well, look, I'm going to start investing. But I didn't really like what the cookie cutter stuff that my bank guy was telling me. I already had like that contrarian inside of me, and he says, oh, buy this mutual fund, buy that. And I said, okay, that's fine, but I want to start doing my research. But I fell in the pitfalls that most investors do. They go on Google, they type investing, and this is a perfect analogy. So whenever you go visit somewhere, a new country, let's say you land here in Paris, the tourist traps are always the first things you see, guys. On Champs-Élysées, the first restaurants, the most accessible ones are the tourist traps. And it's the same thing in the investing world. Before people find your channel, before they find me on Twitter, what they're going to find is the highly publicized paid advertising on Google. So they're going to fall in all the traps. They're going to fall into FOMO-driven headline news, buy Bitcoin, like in 2021 when it was like above 60,000, or you go in the penny stock forums, and because you don't have charts, you don't know. You say, oh, the story's great. It's appealing. It strikes a chord. And then you buy with all your life savings. You have no notions of risk and money management. It's a miracle I didn't get wiped out multiple times. And some of the stocks I put too much of my net worth in it. And then my heart would race at night. And then next day I would sell. And like my instinct were telling me something's off, Pat. And then I started doing my research. I understood, I read the Stan Weinstein's book, Secrets for Profiting in Bull and Bear Markets. Then he talked about risk and money management, charts, how to spot basing patterns and trends. And he had a great analogy. He says in the 1980s, nobody wanted casino stocks, but he was looking at the charts and they had been basing for years and they were starting to break out. And Stan Weinstein said, look, I don't care what the headline news are saying. He was looking at the charts. He's saying there was a new uptrend. Capital flows were coming into those casino stocks. And he wrote that. And then I realized that if you're not looking at the charts, you're just going to hear headline news. And if the headline news, they're talking about it because of past price behavior. Only reason people are talking about Bitcoin in 2021 instead of talking about it in 2013 is because it went up 10,000% or how many percent. But those gains are in the past. Doesn't mean there won't be further gains. But without looking at a chart, it's hard to see if you went parabolic, if you're stretched from the moving averages. And yeah, so that's pretty much it. Right now, I'm doing charting full time. I retired from doing IT a couple of years back, and that's all I do there. I dream about charts. I create charts to always try to find the low risk and high reward setups, and especially with instruments that nobody's talking about, right? Like a little while back, we spotted the sugar. Sugar has doing a nice base breaking out, but who the hell's talking about sugar? Like on Twitter, nobody talks about that. But it was a great opportunity. And yeah, hopefully people, they start looking at charts and forget what the ticker is on the top left. Just start recognizing great basing patterns. And those are the opportunities to go in. Not what you hear about like NVIDIA, up 30% after hours. Well, okay, fine. But look at the chart. NVIDIA is now, it's starting to get stretched from its moving average. It might have some more fuel to go up. But the best opportunity to get into NVIDIA was back in 2016 when it was coming out of a huge base. 2008 to 2016 was created huge base. That was probably the best time to go in NVIDIA. So, man, I went off tangent on that one, right? I started by my background, and then, but it all ties in. So right now, and also there's stuff when you think you have a thesis, guys, and you buy something, and then you see the price go in the direction of your thesis. You think that it's because of your thesis is right that the price moving up. But that happened to me a few times where I bought, let's say, coal stocks because I thought coal, whatever the macro headline news was at the day, the shortage of coal. Then I bought a coal stock. It went up, it went up, it went up. But then the price started falling and the thesis didn't change. So now I'm trapped. What do? Price is going down. the thesis hasn't changed. Do I exit, or I say, oh, the price is going to fix itself? The thesis is right, but it's not the thesis, guys, driving the charts. We could probably cover some charts today, but what's driving the price action is actually capital flows from macro asset classes. So let's say SPX versus gold, or money supply versus SPX, or money supply versus gold. How much these major asset classes are able to strip from the other major asset classes, that's carving the price charts that you see. So if you're a commodity, if gold's breaking out versus SPX, then silver's going to do well, the miners are going to do better, all the commodities are going to do better, and vice versa. When SPX broke out versus gold in 2012 or 13, then you had to go long tech stocks, you had to go long Bitcoin and all these growth instruments. And yeah, so got to be really careful about buying based on a thesis or news, because if the price doesn't agree, you could become a bag holder for many, many years. And sometimes some price charts never come back. Look, if I could give you another example, the cannabis stocks. Cannabis stocks were on a tear. They got legalized in Canada. That was the absolute peak. The thesis didn't change, right? People say, oh, there's going to be more and more people buying weed, whatever the macro is. But the prices for canopy growth since that peak, it's done a full bell curve. It's back at the beginning. So even if somebody believed in the thesis and they didn't want to sell when clearly the rising trend had broken down and momentum was breaking down, without looking at the charts, you cannot see that the momentum has broken down. And then they're trapped. They've been back holders for 5, 6, 7, 8 years. The price might never go back up. One day they'll give up. And the day they give up, these people, is probably when you'll have the next base in weed stocks. And then the price could probably go back up. So yeah, TA guys, it's not astrology for men, and it could really help you not get trapped. And that's important, right?
Astrology for men. Yeah.
Yeah. Max Kaiser said that a while back there. It's like, Jesus, like, it's the way to see it is TA is not binary. It's not, oh, if you, Patrick used TA, how come there's no Lamborghini? How come it doesn't work that way, guys? TA is just, it's not just showing a bar graph. You know how sometimes people put a bar graph and they put a headline news? Well, TA is actually measuring momentum, a rising trend line on a log scale. Price goes up, up, up. After 3 bounces on that rising trend line, if ever there's a close below that, that means the momentum, you're not able to accelerate at the same speed that you were before. You're losing momentum. And then I could draw another trend line, a little less steep. And then that one gets tested. When that breaks down, then what's happening is you're not going up at the same rate and you're going slower and slower. When you're going flatline, the momentum's gone, guys. And that's dangerous. The upwards momentum's gone. So once you're at a flat momentum, now 2 things could happen. Well, the momentum could keep going sideways, but the momentum, yes, can pick up again, but it could, now it's much closer to actually going down. Yeah. And that's, you don't want to be there, right? You want to be above a rising trend line where the momentum, for whatever macro reason, keeps going up. That's what TA does, guys. Just with a simple trend line, forget all the fancy RSI tools, all that. Just one simple trend line could keep you on the right side of a rising trend and get you out when the trend decides to go sideways for a little while. Then you take your money out. Why risk it? And then you wait until that stabilizes. If it picks up again, fine, go back in. But it helps you step away. It's about weighing or establishing the probabilities of the possibility of that uptrend continuing. That's what TA does. It just giving you probabilities. You're in an uptrend above that rising trend line, while the probabilities are it's going to keep going in that direction until the trend line is broken down. So it's not an astrology for men. It's actually very, very scientific. It's actual supply and demand. It's all these people with fundamental stories, macro stories. Look, you might be bullish. I don't know what you're bullish on right now, but you might be bullish something and you're pushing a few $1 billion, but then there's an Arab sheik somewhere. He's not on Twitter, but he's bearish. The same thing, you're bullish, but he's pushing $1 trillion. What you hear on CNBC, well, that's just part of the equation, but there's other people around the world buying and selling. And eventually they buy and sell, they will have to purchase, and you will see that on the chart, right? If the buying pressures override the selling pressures, then you'll have an uptrend. And when that shifts, when there's more selling pressure than buying pressure, then the trend's going to go down. So look, it's kind of boring, but there's no requirement to understand any fundamentals. There's no requirements. You could have fun with that. We could have a great discussion about, but there's no You don't need to understand macro. You don't need to understand fundamentals. You don't need to understand anything about NVIDIA, AMD, Bitcoin. I don't care. Some people, sometimes they say, Patrick, read the white paper on Bitcoin. Like, why? I could try to read that white paper to understand what Bitcoin is. But no matter what I think of it, that's not what the price chart is carving out, right? It's not me that decides, oh, like, there's great ideas that the stock price never went up. And there's bad ideas that the stock price went up. Look, all these crypto, forget Bitcoin, but all the other ones they call them altcoins or whatever they are. They went up hundreds of thousands of percents, these things. And they're totally worthless from the fundamentals. Even the Bitcoin people are telling, oh, they're terrible. But if I overlay the altcoin charts, for Bitcoin chart, they look exactly the same, these charts. So if a Bitcoin chart, which is supposedly better than all the altcoins, and the altcoins are crap, and they're going up, they're doing practically the same chart as Bitcoin, people have to think, okay, well, maybe it's not what the instrument is that's carving out the prices. It's capital flows. It's money coming into speculative tech stocks, driving the price of these asset classes in the same direction, right? Just like in a bull era, let's say for gold miners, silver miners in a bull era, there's a lot of fraudulent companies with no mining permits, bad management that had the same price chart as, let's say, a Barrick Gold, where it's a huge billion-dollar company, same price chart. Because capital flows, once they start heading into a sector, even the terrible companies with bad management, all that, they might actually outperform a real legit company. So that's kind of the lesson, guys. Look, what you think is good and great, well, the market practically doesn't care.
Yeah. I mean, like you mentioned, the media is a lagging indicator of what's already, essentially topped out or close to topping out. And also one thing, to your point there, I'd like to add is, the charts are also a representation of human psychology. So we as humans, we like to head towards pleasure and get away from pain. So that's why we see overshoots to the upside and overshoots to the downside as well. When it comes to mean reversion, we never go straight back down to the mean or straight back down to a support resistance line or trend line, whatever. But we always go all the way down, or we go shoot all the way up. Because we as humans, we see other people, we see other people getting pleasure. We want to pile on and get that pleasure too. But at the same time, when there's fear, we want to get away from fear, even if so the charts are also a representation of, human psychology. Do you have like anything to add there? Like when you look at like a reversal pattern, like a hammer candlestick, that's telling you like, you brought an asset all the way down, but then the buyers simply overwhelmed the sellers and, brought the stock back up to over where it opened. So that's like a signal that, there's simply more buyers than sellers. It's all like it's a representation of human psychology from a buyer's and seller's perspective.
That's right. I'll show you a great example of this. I'll share my screen if you don't mind.
Yeah, go ahead.
It's I'll show you this one here. It's a tweet I did back. Do you see my screen? Yeah.
Yep.
This I did this, and it was very tough to do this tweet back in February of 2021. This was the Bitcoin price. Back then it was, I don't know, 52,000, and it was just rocking upwards. And it's tough to look at a chart and say, you like the laser eyes, everything was going bonkers here, right?
Mm-hmm.
Like Bitcoin could do no wrong. But I said, okay, I'm gonna look at the chart. How far is it away? Like if you talk about mean reversion, here on the bottom pane, I have distance from the 1 year moving average. So you could do TA on anything, on an indicator. So here I have my high water mark. Here, the previous peak in Bitcoin, it got stretched 222% above its 1 year moving average. So I know that that's the fuel it has to stretch away. So to expand away from the mean, even if the mean's inclining, it's able to stretch 222%. If ever I get close to that, I have to take some pause and say, guys, I'm historically stretched from a moving average, a blow off top in Bitcoin, the previous cycle. My expectations now, this is how TA is about weighing the probabilities. Now I have some evidence to tell me, Patrick, we're not here in the fear zone, like you said there. Nobody wants to buy Bitcoin here when it's dropping here extremely low. I don't want to buy there either because it could keep going lower. But when it was close to its 12-month moving average, nobody wanted to buy around here. But look, it was actually creating that base we were talking about, right? A beautiful long base. I could have drawn a breakout line. You have to buy here on the breakout. And then as the expansion happens, here's where CNBC starts talking about it. It's when Michael Saylor starts, Max Cater, and look, all these crypto channels, for crying out loud. Any random crypto guy on Twitter has more followers than I do. Like it's bonkers. All the YouTube channels and all those surprise faces. You've seen all that stuff, right? It's like, if that's not a warning that you're in a bubble zone, I don't know what is, right? But other than all that anecdotal evidence, look at the chart, because that's not anecdotal. The chart is the actual price action. So right before we actually peaked, you could see that we were getting really, really stretched. So I kind of did a little bit of math, but I thought that this moving average, a lot of people will get trapped between 58 and 64K. And that's pretty much what happened, right? The price action went, I'll actually open it here because it's in Trading View. You'll see it live here in Trading View. I could click on the plus side. So it kept shooting up. Then after that, it tried again. But all this is opportunity cost, right? As time moves on, all this time, all the holders, all the people. And I have some people DM me, thank Patrick. I would have loved to have that chart back then, because a lot of people bought at 50K, 60, 30, above 30K. A lot of people bought in between 30 and 50, 60. And these are the bag holders. So what happens over time, here could have drawn a wall here around 35K, 31K. And that, hear me?
Yeah, I can hear you. Go ahead.
Okay. That wall becomes resistance. So now for Bitcoin, I'm not even going to think about it until it's able to recapture at least the 35K and retest it from above, and then stay there and create a beautiful base. Look, this is what I want to see, right? We're about here, there right now, like the equivalent. I want to see a beautiful, beautiful coiling base. And if ever I see that, then I want to play that again. So
do you apply any fractal analysis by copying previous patterns?
Yeah, I do that sometimes. I used to have a lot of fun with that, but they're dangerous because after that, it's almost like bias. You're projecting. Yeah. Because that's the Bitcoin guys. That's what they keep. They keep showing over and over. They keep doing these. Here, I have my fractal tool. You know, they do this, and then they say, "Look, I did it again," and then it's gonna do it again. You know what I mean? Like, but that's fine. It's a possible roadmap, but the TA has to. The actual breakout line has to. Look, this is where the line is. That's possible, but there's no reason to front run it until the actual breakout line, until this line or wherever it settles. There's no reason to front run that, right? You say, okay, it's a possible roadmap, that's fine, but you have to wait, because what's going to happen here, all this is opportunity cost. If you try to jump the gun, you could be grinding sideways for years, and you could even have a massive drop here. Look at this drop. It went sideways here in 2019. Look at that. That's a wick. But the price went down. I don't know how many percent it went down there. Let me just measure that. It went down massive here in March. Went down 58%. Wow.
Is that a log chart?
Yeah, it's log. Yeah. So if people, they buy early here and the price goes that, they have to be willing to accept that if ever there's a huge sell-off, the price could go all the way, like, you know, really down. And emotional, there's another thing that people don't notice is it's called emotional capital. So you have your NAV, your net asset value, like real capital to invest, but there's emotional capital, because if you buy early because, oh, I bought the low, it's going up, and then the price going down, and then it drags on month after month, and you're looking at the daily price and you haven't broken out to get sustained a bull run, you know, like month after month of green, then that's going to erode your emotional capital. And eventually you could wake up one day, you're tired, you got an argument with your wife, the kids are annoying you, and it just happens that day that the price action went down 8%, you might just panic sell. And you don't even you're not going to be rational anymore if you don't have mental fortitude. So opportunity cost is not just looking at a graph and saying I'm losing time, is you're more vulnerable to drawdowns. When you're below these lines here, you're more vulnerable to huge sell-offs and wicks. And if you run out of emotional capital, then you're not going to think clearly, and you're going to take decisions that are going to be worse. You might decide to double down. You might decide to do a whole bunch of stuff. And once you start taking these decisions, then you're putting yourself in the corner. Because imagine, I'll show you canopy growth. Weed canopy growth.
Okay.
Look at canopy growth, crying out loud. It went up. It's going back to inception.
Yeah. Textbook bell pattern.
Yeah. And until this line here, let's say Bitcoin's here, it's rising up, until you're able to have a bullish roadmap here. Look, somebody would have done a fractal here. Let me get my fractal tool. It says, oh, look, somebody could have said, oh, look, I have a fractal here. It's going to do it again. Okay, fine, possible roadmap. But it has to clear that important wall here, that breakout line.
Yeah.
And right now, until canopy growth. So look, I'm not saying this happening to Bitcoin, but GM, there's a whole bunch of charts that are doing the whole bell curve, going back to inception, for crying out loud. Look, that thing was 80, 69, and it's back. Jesus, look at that. It's back at $1. There's tons of examples like this. It doesn't mean
that's an 8-year stretch of time you would have had to hold to come back to make a full circle retracement back.
It's you have no more emotional capital after that.
Yeah.
And you have no more capital. And then you have to explain to your wife that you lost a whole life savings because you had a hunch and you bet a bunch on cannabis stocks. You didn't use risk and money management. You're trapping yourself. Look, here's Target. I did this chart this morning for on Twitter. I'll just pop up the.
So when a stock like Target, like we just saw, hits a support line, what are some of the indicators that you look for to tell you whether or not it's going to bounce off that support line or just break down below it?
Well, indicators, you mean if I add, let's say, like a RSI or some type of...
It doesn't have to be like a formal indicator, but just like something that you look for to help you in determining whether it's going to sway, whether it's going to break down below or just bounce off it.
Well, that's it. So the bounce, a valid trend line needs 3 bounce to morph into existence. And once you have those 3 bounces here, let's say on this continuation pattern. So this is a pull flag, bear flag. So a pull down, sideways move, it grinds upwards, but in a flag pattern. 1 touch, 2, 3. Well, on the bottom, 1, 2, 3 bounces on the bottom trend line. So that's valid. So if ever there's a close below that trend line, that's market telling you that it's lost important support. And then after that, you have a measured move. So whatever the distance was from the beginning of the flag, the pull, you add it at the bottom. So for Target right now, its target is back all the way at $82, which is also a wall. So sometimes you have measured moves as defined by the classical chart patterns, but then you have to take a step back and see, okay, well, where's my wall? Previous resistance. So this breakout line here was resistance. It broke above. Now that's support. So even if you had a measured move that would have a target, let's say at 56, a non-greedy target to exit, let's say you would decide to short the target at the stage, would probably be around the 80, 90 level. That's probably where you would expect this thing to start capitulating. And then we go in your scenario where there's probably going to be a crazy wick down, and then like very far off the mean. Look, let's do it. Let's do the here's target. Here at the bottom pane is distance from the 3-year moving average. And look at that. You see how all these high watermarks here? That's how far it could get stretched from the 3-year moving average historically before pulling back and going sideways. Here, it peaked. Here, look at that. Even 20 years later or 22 years later, it got stretched 100% above its 3-year moving average, and then the price reverted down. So right here, you could expect the price to get stretched maybe 38% below the 3-year moving average before 38% before finding a bottom. So let's do 38% about here. I'm just going to zoom in. The red line, guy, is the 3-year moving average. So the price, here's my 3-year moving average. If right now it goes bonkers and it stretches 38% or 40% away from its 3-year moving average, this is probably an area where it's going to start bottoming. But if it takes more time to go down, so if it goes down in lockstep, that 3-year moving average is going to start rolling over, and this is a sliding target. So you could get lower and lower targets. But yeah, right now, the 90 zone, $100, that looks pretty much where it could go easily. Yeah, 110, in between 110 to $90. That's where target's heading without any much difficulty.
Got it. Well, are there any so what sectors are you looking at now that you're kind of seeing? Like, are there any inflection points that you're seeing with any sectors in particular that could indicate that we could see an upward trend up or a break to the downside?
Well, semiconductors are doing pretty good. So semiconductors, they're above the rising Ichimoku cloud, above the 3-year moving average. The thin blue line is the 1-year moving average. So I had a dip below, but right now it's just powering upwards. It's not a nice, beautiful base like I would have loved to see in here. You see how that's a beautiful, look, 2001 all the way to 2013. That's a 12-year base. A 12-year base will increases the probabilities of having a beautiful, look at that, never close below the 3-year moving average, a beautiful uptrend. So this is tricky. While you have some bullishness on this continuation pattern, your expectations of having this type of move, a huge move like it did off this bottom, the probabilities are much lower. And you'll see here at the bottom, here's my distance from 3-year moving average. I could even do TA on that. But this is, look, the momentum, you could define it as how far you could stretch away from the 3-year moving average. There's a topping pattern here. So the momentum was always able to go up, down, higher lows. But now the momentum broke down. So while the price is going up, the momentum is not doing new highs. See how it's always able to expand higher and higher away from its 3-year moving average. While the price now is moving up, the momentum has actually broken down. So that's a bearish news for, it's giving me pause instead of going all in like I would after a huge 13-year base. I see that and I say, this thing, it's not like happening here. You see the momentum here, how it puked and then it broke out, retested from above. As the price was getting bullish, more and more bullish, this is not very, very constructive from that. So if you want to look under the hoods, yes, this thing is moving up. Is it a blow off top? Is it just going to stretch up and after that fizzle out? It's tough to say, but this is not, it's looking bullish here, but it's not as bullish as it was after 10, 12, 13-year base. Because I'll show you one chart, which is the SPX divided by producer price index. Well, you know what? I have it done here on my pinned tweet. Essentially, this is the battle of the major asset classes. So SPX, growth stocks, whatever, divided by a producer price index, which is a great proxy for inflation. So that chart goes back all the way to 1914. Whenever SPX breaks down, like those trend lines we covered, right? If ever there's a trend line break, that means momentum slows down, and then it closed below the 7-year moving average. So another indication of a trend of momentum shift. It took years, decades for SPX to create a base and break out once again versus inflation. Here's the 1960s. It did, even if it broke down below the sleep mode line, SPX still managed to hold its own for a little while versus SPPI. But then it faltered. Rug pulls are more probable once you're below a rising trend line. Here's the 2000 bubble, the 1980 to 2000 bubble for SPX versus producer price index. Broke down below the 7-year moving average. So now after that, you get more recessions, you get more rug pulls. It goes sideways for a decade. Look, that chart I did a while back, but it's practically still the same. It's below the rising trend line. It's hanging around the 7-year moving average. So while the SPX can nominally do maybe a new high like it did in the late 60s, it's more susceptible now of having rug pulls. And you see it while the semiconductors, are doing great or better. You saw Target and other sectors, which are, Target is starting to break down massively. Look, once this rising, so here's that chart, I'm doing it live. The momentum here broke down below the 3-year moving average. So this, you have to consider this a bear market rally for SPX versus producer price index. You're at the same stages that you were maybe here, hanging around here. You're here. Let's go back to the 60s. A little tricky. You could be around here. So it could even here, it could go, it could surprise us, right? The US equities normally could keep hanging in there.
Yeah. So essentially the market's outpacing wholesale producer prices.
When this goes up, yes.
Yeah.
But once you get a clear breakdown here, that means the upwards momentum, the outpacing, the upwards momentum that the US equities had versus, the commodity prices, input prices, you know, which probably hurts their margins or like, you know, the profit, whatever fundamental guys want to insert any fundamental metrics in there. It's kind of a game changer because now you've seen this is like only the fourth single in over 100 years. They're not overturned that easily, that loss of momentum. You know, it's like you're running uphill, you trip, but because you're running, you're still able to go up a little bit more, but you're not able to go up that hill as fast as you did when you had full speed before going up the hill, right? It's harder and harder, and you're more vulnerable of just eventually just losing energy and just rolling downwards, back downwards until everybody capitulates and you're able to base yourself, and then you start over. And that's what the charts visualize. That's what the charts help you. Forget all the headline news, all the headline news, it's hard to visualize actually what's happening. But a chart like that, it just tells you, okay, that's where I am. Yes, there could be rallies in the outperforming sectors, semiconductors and technology and all that. They're doing great rallies, but they're still vulnerable for rug pulls because as a whole, the US equities, the 11 sectors that are comprised in the SPX, they're not able as a whole to outperform in a sustained fashion like they did in the entire like 1980s and 90s, or like they did in the 1950s or 60s, the Nifty 50, right? As they went up. So the macro landscape is still bearish US equities, but that does not mean they go down to zero, right? It just means they're no man's land. It's going to be harder and harder for them to go on a tear. They're going to have more red days than they used to have in a bull run. People are just going to get destroyed left and right there, and their emotional capital is going to get drained for the next 4, 5, 6, 8, 10 years as that thing just grinds sideways.
Yeah, and I like the fact that you referenced a ratio there. That's something that I always use here on the channel as well, because you're comparing it to something else as opposed to just a dollar, which is a moving target. And also another thing to add to your point there is when you're looking at these past performance patterns, like you just did with the SPX versus PPI, and you compared prior drawdowns to what we could foresee today. Why that's so relevant is because at the end of the day, these are humans trading. Yeah, I know you've got trading algos and whatever, but by and large, these are humans trading these things. And we as humans, we have the same tendencies as we did 10 years ago, 20 years ago, 100 years ago, even more than that. So it's like we talked about before, you know, we behave in similar fashions. You know, it may not be an exact replica, but it'll, like Mark Twain said, history doesn't repeat, but it does rhyme in a certain way. So, you know, it's just wanted to highlight that to the audience as well. Now, we're seeing in the precious metals prices, we almost touched the all-time high when it comes to gold. We're about, I don't know, like 1940, in the mid 1900s now. What do you see in terms of the precious metals heading out?
Okay, well, precious metals right now, they're banging on heaven's door. So you have to be careful. Now what's critical, the precious metals are really going to start flying once gold is able to break out versus SPX. Okay, I'll share my screen again just to give.
Yeah, for sure.
So I'll just do it. I did it so many times. XAU, so XAU versus SPX, same thing. Racial charts, guys, because people have to forget denominated in fiat. People say, oh, Patrick, well, I only buy in fiat. Fine. But fiat, they could debase it, keep adding zeros, and you think you feel good, right? Oh, my house has a zero. It's not worth 40. It's worth 400,000. But if the gold price went up, that means your purchasing power went down. So you're not that much richer, guys, because everything else is costing more, right? That's why people have to start measuring in something that's real. Here is the gold versus SPX. So while nominally gold is at all-time highs, the ratio of gold versus SPX is not at all-time highs. Here's the all-time highs, 1980. Before that, it was peg gold practically. So this is mostly the SPX driving this portion of the chart. So nominally, they've been debasing so much to keep the SPX afloat. Gold has been pricing it in. So gold is close to all-time highs on its chart. SPX is also going up because this ratio is lower here, then SPX has gone up more since 1980 versus gold, even if gold nominally is up also at all-time highs. So to have a bull run in precious metals for gold to really start outperforming SPX. So if people think gold is expensive now, it's nothing because it hasn't even broken out versus SPX. Because here in 1971, we're at exactly the same level practically that we were after this base of gold versus SPX. That's when the true appreciation happens in gold. That's when the true destruction of purchasing power accelerates. Silver goes up. Look, I'll overlay the silver chart. And you'll see that silver tracks the capital flows as defined by the gold to SPX ratio. Look at that. Here's my silver chart. Silver tracks the gold to SPX chart. Look at that, practically. So if people are wondering, well, how come gold's not at all-time high, silver's not at all-time highs, gold is? Well, because silver does not track gold. Silver tracks gold's performance versus the SPX. And so did the miners. I could have put the ASA chart, which is the gold and silver index since the 1960s. It's better than the JDX and the Huey because you just get more data. And look at that. Same thing for the gold and silver miners. They track how much capital flows gold is able to steal from the SPX. Look in the 1970s.
Yep.
Look at that. Look at the run here. So if you're wondering why your gold miners suck and your silver miners suck, well, it's because the gold to SPX chart is not breaking out yet, but it's getting close. Right now, we're back at levels in the 1970 when it broke out. Here's the dot-com bubble where gold really got too hammered. So that's a huge base in the 2000s, which broke out in 2007. When gold is worth half of the SPX, for me, that's the magic number. And you see here the wicks. So intra-month, gold looked like it was breaking out versus SPX, but the sellers came in. But there are higher lows, higher lows. This line here, if ever gold is able to close above here, it's going to try to go, it's going to go all the way. It's going to rocket all the way up here to the 2020 highs of gold versus SPX, which was actually a bear market rally in this downtrend. So gold was in the bear market here versus SPX. And when gold went up from 1200 all the way to 2000, that was actually just a bear market rally slowing the downtrend enough. Now we have a bigger base. This is a huge, huge, huge base. And if ever that base breaks out, I'll just highlight it. That's a massive, massive base. And this is probably just going to do a little roadmap. If ever this breaks out, we're going to go here, retest from above. And then this is where your miner, silver, gold goes totally bonkers. It doesn't mean US equities go down the drain. It just means that gold and silver and the miners will outperform US equities. And that's the takeaway, guys, is if I show you a ratio chart and I'm telling you, you have to own either of those. A ratio chart will tell you which one to hold, right? So even if both instruments are going down and I'm forcing you to hold one or the other, you'll want the one that's going down less fast. And the same thing on the way up. If SPX is going up and everybody, SPX going up, but gold's in a bull era versus SPX and gold price going up, why the hell are you holding SPX? You should be holding more gold because it's outperforming on the way up.
Yep. So are there any other reasons aside from the gold to SPX ratio not breaking out yet in terms of why the gold and silver equities have lagged behind the metals?
That's right. Well, exactly for that reason. So if gold, they're waiting for gold to prove that it's a bull era for commodities, that people have given up on the markets, or the markets are going sideways, that more purchasing power and acceleration in destruction of purchasing power is required to nominally keep afloat, the US equities bailouts, whatever they need to do to offset the US equities plunging to keep them afloat. So bear market or sideways move for 10 years for US equities. Once the market senses that that's inevitable and that's going to be a prolonged healing process. Then gold will start outperforming SPX, and then that opens the tidal wave of the gold and silver minor charts, which are overlaid on the gold to SPX chart. Silver, they're waiting for gold to actually break out versus SPX. So until then, the SPX is not 100% dead, but there's a lot of evidence, like you saw, it broke down versus the PPI, etc. There's a lot of evidence that it's vulnerable to go in that prolonged hibernation there versus commodities, or at least the precious metals and the miners.
Yeah, and to add some more sizzle to your steak, in regards to the charts that we just looked at for gold relative to the SPX, institutional investment has dwindled down to about 0.5% of their portfolio in gold. Historically, that's been around 2%. So even if we just revert back to the 2% mean, that's essentially a 4x demand from institutional investors in the gold price. So, we're in an anomalous time when gold holdings are at a significant low versus where they typically been with institutional investors and retail investors as well. So, to add to your point there, that there's a lot of potential energy to move up.
Yes, fuel. It's fuel in the gas tank, and all this with gold hogging all-time highs in price. It's totally bonkers. It's like there's no gold is bottoming versus SPX, and then you could put in all these other macro metrics where investment is at slowest, yet nominally gold's price is at all-time highs. So that's great. So another example, that gold to SPX ratio is rock bottom, right? But the price is much, much higher, right? Because we're the same ratio of SPX to gold that we were in the 1972s, or we were back in the mid 2000s, but for a gold price much higher. So that should be a wake-up call. That's how much purchasing power they destroyed, because an ounce of gold is an ounce of gold. If you're adding zeros, if the price of gold is going up, it's not gold being different. It's actually your fiat being able to purchase less.
Totally. What about uranium? Where are you seeing uranium now when it comes to the commodity itself, as well as the equities? The commodities is sitting at around $54. I was looking at it the other day, and we've actually been hugging an ascending support line up, and we've actually broken out of an ascending triangular pattern as well. So what do you think about uranium?
Uranium is going to do great. It's going to be, I could have overlaid the uranium miners on that chart, even the spot price of uranium. I had a long-term sample somewhere, and it tracks the same thing. So when gold breaks out versus SPX, hold on tight, because Cameco and all that stuff, anything that's related to uranium, it tracks exactly that. Platinum, uranium, crude oil. Crude oil is a special beast. Crude oil tracks, or the CPI tracks crude oil, and crude oil also tracks your destruction of purchasing power. So it does both. The volatility in crude oil is actually, I could overlay that, and it looks exactly like the year-over-year inflation rate for the US, but over long periods of time, instead of just oscillating like the CPI does, in between a range of, I don't know what, 2% or whatever, 10% over all those years. It creates higher and higher plateaus because it prices in the accumulation effect of destruction of purchasing power. And this stuff accelerates when gold breaks out versus SPX, when gold breaks out versus CPI. Oil does great, uranium does great. Like, it's not lockstep. It's not like gold's going to go up, oil might go sideways. Then after that, oil has its turn. But if you zoom out, I overlay all these commodities I named you. All the charts start bottom left to top right in these bull eras. Yeah, so uranium, it's gonna do also pretty good there.
Perfect. And we had a pretty significant drawdown in nat gas. Have you been looking at that as well?
Man. Nat gas. I looked at that chart because a lot of people, they try to catch the bottom a little while back. I don't want to touch it because it needs time to heal, but that chart is messy. So it's sometimes some TA charts, you could do TA. I could look at a chart and I see exactly, that chart looks like that ratio of those major asset classes. So I know exactly what macro capital flows carve out that chart. Natural gas, it's a total mess. So Yeah, it's I can't really read it in it doesn't really track gold versus SPX. It doesn't really track crude oil. It kind of does its own thing. But right now, I don't like catching falling knives because again, you think it's cheap, but it could stay cheap for 6, 7, 8, 10 months. And then while your capital is locked in there, gold could be breaking out versus SPX. You should be, and because you're holding something and praying and hoping that your thing goes up, you're going to miss the boat on the actual breakout of gold, you know, or whatever other instruments breaking on that time. So something cheap can get cheaper, but if it doesn't get cheaper, it could stay cheap for a long time. It's like, wait until it breaks out. I think I did some charts. I had a clear breakout line. It needs to base. It needs to work its thing. And then eventually there'll be a move to do in natural gas. But yeah, I'm not touching that yet.
Yeah. So, I mean, the quickest way to lose 99% of your money is to lose 90% of it and lose another 90% afterwards. Right.
Yeah.
So,
yeah, exactly. You want to, and that's the thing people have a hard time understanding. Most of the breakouts I play, the price have moved 100% off the bottom, but that's how you start building an uptrend, guys. You need a strong move up, create a higher low, then it's gonna goes up 100% off the bottom. People, Patrick, you missed the bottom 100%. I didn't miss anything yet because the chart hasn't proven to me that I'm in a new bull run. Then it corrects 50%, then it creates a higher low, then it turns up. That's when I get interested. I don't care about something moving up 100% because that's hindsight looking. It could have easily kept going down and down, like you said, 90%, then go down 90%. I don't want to get trapped ever because I know if I run out of emotional capital, I'm going to be like a poker on tilt, and we know how that ends, right?
Totally. Well, I want to be respectful of your time, Patrick. Thank you so much for coming on. How can the audience find you?
Well, guys, just go have fun on Twitter. It's the Wild Wild West there. I also have a website with my friend Kevin Wadsworth on northstarbatcharts.com. And yeah, have fun, guys. Look at the charts. It's not astrology for men, and it can save you from a great emotional capital loss.
Great. Any other closing thoughts before we sign off?
No, it was fun talking on your show for the first time there, and maybe we get to do that a little while in the future.
Definitely. Well, if you haven't already, guys, be sure to hit the subscribe button for the channel. It'd really help us out, get more interviews like we did with Patrick here. And if you enjoyed this video, give it a like. And until next time, guys, I will see you in the next video. Bye, y'all.